Our next guest likes mid-caps in the near term. Joining us right now is Carey Hall. She's the head of U.S. small and mid-cap strategy and senior U.S. equity strategist for Bank of America Global Research. Why mid-caps?
So I think, when you think about Fed cutting, obviously this is supposed to be a positive for small caps. They've actually underperformed since the 50 basis point cut. And I think the reason is a lot of investors are now looking at the fundamentals for smaller companies, and they've still been stuck in an earnings recession. We haven't seen that recovery to positive growth the way that we've seen for larger stocks. So I think mid caps could be a better hedge for the near term. They've seen better earnings and guidance trends, and they've historically still done well and oftentimes better than small caps following the initial Fed rate cuts historically. So I think for those that want to tilt down the cap spectrum, that's a better area than small caps right now.
We had somebody tell us yesterday that small businesses still have to pay about 10% interest on average to get a loan, even though the Fed has cut rates at this point. Is that part of the thesis, that for small business it still takes a while, even after the Fed starts cutting rates, for that to trickle down?
Well, I think, certainly for some small businesses and others maybe more tied immediately to the Fed funds rate. I think overall, one rate cut is not going to solve the refinancing risk that small caps face. You still have about half of their debt that's short-term or floating rate. So, the more rate cuts we get, the more that helps to mitigate the refinancing risk that a lot of these companies face. But, there's also some sector specifics. There are sectors like real estate and tech within small caps that even if we get a handful of rate cuts, they still do face a lot of refinancing risk.
Are there sectors you like within the mid caps too?
I think overall, within both small and mid caps, I think this is an environment where, you want to focus on themes or styles, even more so than sectors, because, within small caps, even though we've still been tactically cautious just given the fundamental backdrop, obviously if we're in a soft landing, which is our base case, and if we're in an environment where the data holds up, the Fed's cutting rates, if we start to see revision trends and corporate commentary turn around, then maybe later this year, once we get past the election, it could be a better environment for small caps. Usually volatility, which small caps are negatively correlated with, stays high ahead of that. So I think for now, just focusing on stocks that have positive rather than negative revisions, those have been rewarded, higher quality stocks, and even stocks that have dividend yields, because as the Fed's cutting rates, that should drive money out of shorter duration assets and into equity income.
Are there issues that you see with, I guess, the economy coming on? We've had a lot of discussions this morning about whether the economy is starting to turn down, whether it's more complicated. What does it look like from your perspective?
Yeah, I think overall, we've certainly been in a weak macro environment recently, which is, one of the reasons why overall corporate earnings, may see a bit of a dip this quarter. We think we'll see a reacceleration after this quarter. And I think when you look at the balance of data, we're still expecting the U.S. to stay out of recession. Obviously, the recent data in terms of GDP revisions and jobs data recently has been encouraging. So, we'll see if that continues. We track a regime indicator on our team, and that, after being in a more positive phase for much of the year, had turned down into more of a downturn phase for the last 2 months, which tends to be a phase where you don't want to own small caps and risky stocks. You want to tilt up the cap spectrum and stick with quality. But it's also been volatile in terms of some of the underlying components.
Did you see Mark Rowan of Apollo saying that he did not think that there should be additional cuts on interest rates because he thought the economy was doing so well that it was actually a mistake to cut interest rates? Shocking from a person who's in the private equity business in large part, who you would think would want rates to be as low as humanly possible.
Yeah, I think, the rate cuts for the overall market, corporates have been able to adapt to higher rates. And, especially for large cap stocks, they've been able to do well in this environment. And, we've been in an environment where the economy has held up. A year ago, many were expecting recession. We've managed to stay out of that. I still think for small caps, that was the biggest focus. And one of the biggest reasons we saw that big rally in July in the Russell was because investors have become so focused on the Fed as a catalyst for smaller companies, given how much investors have become focused on the refinancing risk that these companies face. So, I think for smaller companies, that's really where the issue lies, since large caps have been able to adapt, and particularly for some sectors.
If the labor market really is the slightest bit indicating some weakness, I could understand it. But if it's just to keep if the default move is to keep the punch bowl going because people love easy money, or because you're worried about that, then I don't think.
Mark Rowan's point, I'm just looking at it now, the risk is that we accelerate the economy and have to go in the other direction, and that would not be a good day if inflation.
That's why I was thinking the Fed knew something about the labor market, and then the labor market has that report. It's like, what was the 50 all about? It's not the stock market, and the last 20 years we have become addicted to. We just love the party, Wall Street traders. We love oh my God, low interest rates. Oh, it's the greatest. But if you don't need them, I think you should save it for when you need it.
Save it for when you need it. But it also suggests that things then are very good. That to me was sort of the underlying piece of it, which, given the number of people who come on and try to tell us that everything is terrible.
But the Fed seems to be thinking that it's, I don't know, like illusory that it's so good. I don't know.
Well, it's a unique backdrop. I mean, the Fed's cutting into an accelerating corporate profit cycle, which isn't, something that frequently happens, so maybe reflationary. So, within our overall equity market outlook and within the S&P as well, we've, had some overweights on some of the cyclical sectors that could benefit in this backdrop.